How strong is your investment portfolio? It's easy to feel confident when the market is going up, but what happens during a market crash? A recession? Or a period of high inflation? That's where a portfolio stress test becomes useful. So I decided to try an experiment. I asked AI to stress test a beginner investment portfolio using different market scenarios. Could it identify weaknesses? Would it suggest any improvements? And most importantly, could it help me become a better long-term investor? This isn't about predicting the future or guaranteeing returns. It's about understanding risk and preparing for different market conditions. Let's see what AI found. What is a portfolio stress test? A stress test is simply a way of asking, what might happen if the market doesn't go as planned? Instead of focusing only on potential gains, a stress test explores how a portfolio could perform under difficult conditions. For example, a sharp stock market decline, high inflation, rising interest rates, a recession, a slow economic recovery. No one can predict exactly what will happen, but thinking through these scenarios can help investors understand how much risk they're taking. The portfolio. For this experiment, I used a simple beginner portfolio. It included a mix of diversified investments rather than individual stock picks. The goal wasn't to build the highest return portfolio. The goal was to build one that could weather different market environments. I shared the portfolio allocation, investment goals, and long-term time horizon with AI. Then I asked, how would this portfolio perform under different market conditions, and what potential weaknesses should I be aware of? Scenario 1. Market correction. The first scenario was a broad market decline. AI explained that even a diversified portfolio would likely lose value in the short term. That's normal. The important point was not to panic. It emphasized that short-term volatility is part of long-term investing. For beginner investors, understanding this before it happens can help prevent emotional decisions during market downturns. Scenario 2. High inflation. Next came inflation. AI explained that rising prices reduce purchasing power, meaning your money buys less over time. Some investments may handle inflation better than others, while cash loses value if inflation stays high for an extended period. The lesson wasn't to eliminate cash. It was to understand the role each asset plays within a diversified portfolio. Scenario 3. Rising interest rates. The next test involved higher interest rates. AI pointed out that some investments may face additional pressure when borrowing becomes more expensive. Again, the recommendation wasn't to chase whatever performs best. Instead, AI highlighted the importance of reviewing asset allocation and making sure the portfolio still aligns with long-term goals. The biggest weakness AI found. Interestingly, AI didn't identify a specific investment as the biggest weakness. Instead, it focused on investor behavior. It suggested that the greatest risk wasn't necessarily the portfolio itself. It was the possibility of making emotional decisions during market volatility. Selling after prices fall, buying after prices rise, changing strategies too often. These behaviors can hurt long-term results more than temporary market movements. That reminder was probably the most valuable insight from the entire experiment. What surprised me most? I expected AI to point out flaws in the portfolio. Instead, it spent more time discussing preparation. It encouraged setting realistic expectations, maintaining diversification, reviewing investments periodically, and sticking to a long-term plan. That shifted my mindset. A strong portfolio isn't one that never goes down. It's one you're prepared to hold through different market conditions. Final thoughts. So, did AI successfully stress test my portfolio? Yes, but not by predicting the future. It helped me think through possible scenarios, understand potential risks, and ask better questions about my investments. For beginners, that's incredibly valuable. Because successful investing isn't about predicting every market move, it's about building a portfolio you understand, managing risk wisely, and staying committed to your long-term goals. If you had AI review your investment portfolio, what question would you ask first? Leave it in the comments. If you enjoyed this experiment, don't forget to like, subscribe, and join me for more practical AI and personal finance content here on Zitty Money Mind. Thanks for watching, and I'll see you in the next video.